All right, let's get right into it. Today, we are digging into a huge and honestly pretty controversial idea, what some are calling the 12 trillion trap. We're going to break down this claim that there is a system set up by central bankers that's having a massive impact on your money.
And that leads us to the big question, the one that's at the heart of this whole thing. Is it actually possible that the money you're working so hard to save is being eaten away, not by some accident, but as a direct result of official policy? It's a really heavy question, and to even begin to answer it, we have to look at the argument behind it.
Welcome to Money Flow IQs, where money meets learning. We empower individuals to master financial literacy for lasting stability. Our service equips you to make informed decisions about budgeting and saving. Join Money Flow IQs today to achieve your financial goals.
Wow. I mean, that is a statement that does not pull any punches. This quote frames the Federal Reserve's actions not as some kind of economic rescue, but as a deliberate, systematic destruction of wealth. So our job here is to figure out what could possibly be behind such a dramatic claim.
So where does this whole idea of a multi-trillion-dollar trap even come from? Let's break down the theory that this entire conversation is built on.
Okay, so the core argument here is that for years now, the financial world has kind of been tilted. The idea is that these unconventional policies, which were put in place after the 2008 crisis, ended up creating a system that really rewards people who own assets, stocks, real estate, while the average person who's just trying to save cash gets left in the dust.
But how would a system like that actually work? I mean, it's not some kind of magic trick, right? It's based on some very specific economic tools and theories. So let's get into the nitty-gritty of the supposed mechanism. The term you absolutely have to know here is quantitative easing, or just QE. Now, on paper, it sounds pretty technical but straightforward. The Fed, which is the central bank, basically creates new money out of thin air to buy financial assets, usually government bonds. The whole point is to pump cash into the system and get the economy moving again. Okay, so here's the critical part, how this actually plays out, according to what's called the portfolio balance channel theory. Step 1, the Fed just creates money. Step 2, it uses that brand new money to buy up tons of really safe assets, like government bonds. Now, when you buy that much of something, the price goes up. And for bonds, that means the interest rate, or the yield, goes way, way down. So what happens when the safest investments on the planet pay you next to nothing? Well, investors, everyone from huge pension funds to regular people, are basically forced to move their money into riskier things, like the stock market or real estate, just to get any kind of return.
So, that's the theory. But what do the actual numbers say? Well, the people who believe this argument point to some pretty mind-boggling data to back it all up. Let's take a look. First off, just consider the sheer scale of this whole operation. One of our sources puts the Fed's balance sheet, which is just a list of all the stuff it's bought, at a staggering $6.7 trillion. To put that in perspective, this isn't just a minor policy adjustment. It's like a complete rewrite of the financial system's rulebook. And you can see how that translated into the money actually floating around in the economy. The M1 money supply, that's basically the most accessible cash, the stuff in your bank and checking accounts, grew more in the decade after 2008 than it did in the entire 48 years before that combined. I mean, look at that chart. The scale of this increase, we've just never seen anything like it.
When you make a move that big, you're bound to create some serious ripple effects, whether you meant to or not. So let's talk about those consequences and see how this all builds into what some are calling a trap.
This really gets to the core disconnect that critics point out. The stated goal was to help the real economy, create jobs, help businesses grow. But, they argue, the actual outcome was just inflating the prices of stocks and real estate. The goal was financial stability, but by making safe investments worthless, it allegedly pushed everyone to take on way more risk, which could actually create the next big instability.
And this brings us to what one writer calls his scary graph. It shows the total wealth of all households compared to what they make in a year, and you can see it plain as day. That first spike is the dot-com bubble. The next, even bigger spike is the 2008 housing bubble. But then, look at where we are now. The ratio is way higher than either of those peaks. And critics argue this is a direct result of that policy, of pushing investors into assets and blowing their prices up to historic levels. So, what does this all mean for a regular person? Well, first, if you're trying to be responsible, a saver or a retiree, your savings account earns basically nothing. You're actually being punished for saving money. Second, you've got these massive pension funds that need to make money to pay out retirees. They can't do it with safe bonds anymore, so they're also forced into riskier investments. And this leads to what one source calls an impossible choice for the Fed. Either they let interest rates go back up, which could crash these superinflated markets, or they have to keep printing more money, which risks causing major inflation.
Okay, but it is really important to understand that not all the critics agree on why these policies were a problem. To get the full picture, let's look at a totally different argument from the Macro Musings blog, which, well, it takes almost the exact opposite view.
Now, this is a really fascinating twist, isn't it? The whole argument we've just been looking at is that the Fed did way too much, that its policies were just too powerful and distorted everything. But what if the real issue was that these policies were actually too timid, too weak to actually work in the first place? And this quote really gets to the heart of this counterargument. The author argues that QE was kind of flawed from the very start. It was like trying to put out a forest fire with a garden hose. The programs were just never powerful enough to create the big economic rebound they were supposed to.
So why was it too weak?
Well, the reasoning here is a little subtle, but it's super important. For QE to really change people's behavior and get them spending again, the market had to believe that this new money was here for good, that it was permanent. But the Fed always said that it planned to reverse the policy later on. So by basically telling everyone, hey, this is just temporary, they undercut the policy's power right from the start. Okay, so we've just walked through two very different and pretty compelling critiques of what the Fed's been up to. One says they did way too much, and the other says they did it all wrong. So, where in the world does that leave us?
Let's just put these two big ideas right next to each other to make it clear. You've got the first critique: the Fed went way too far, blew up huge bubbles, and created this dangerous credit trap. Then you have the second critique: nope, the Fed's policies were actually too weak and ineffective because they never really committed to them in the first place.
And that brings us to the final and most important question. No matter which critique you lean towards, whether the policy was too strong or too weak, have we ended up in a credit trap anyway? A system that is so hooked on cheap money and high asset prices that there's no easy way out. And the real billion-dollar or maybe trillion-dollar question is, what happens when that trap finally springs?
Subscribe for more smart money ideas every week.